Take a close look at this dollar. It's hard to see, but its value is actually shrinking. This dollar is shrinking over time. If you put it in the bank or under your mattress, it'll keep on shrinking. In 1970, this dollar could have bought a person 4 loaves of bread. Today, it'll barely buy you a cup of coffee, and a loaf of bread is almost $4. This shrinking of the value of money over time is called inflation. But there are places you can put your money where it'll grow instead of shrink. And those 2 places are either through real estate or investing in the stock market. So what are stocks? Stocks are tiny pieces of the value of a company. Investing in stocks lets you be a part of the exciting work that happens in a company. You give them a little bit of your money to make that work possible, and then if and when you sell your stock, if you're lucky or if you're smart and careful, then you might find that that original dollar that you put in there has multiplied. Your dollar shared with all the work of those smart and creative people, and you get to reap part of the reward because you were a part of that process. So if you have a little bit of your hard-earned money to spare, you can invest it in the stock market. Where, as I said, if you're careful and if you're patient, then you might see it grow instead of shrink. Before I started researching this topic, I really didn't know anything about investing. But doing some research on reputable websites like The Motley Fool, which is a National Public Radio site, and Investopedia, I've learned some of those basics, and my husband and I actually put a little bit of our own money aside in stocks. Investing in the stock market is actually pretty easy, and if you're careful and patient, you might just find that it's a great way to hold onto the value of your money and even see your money grow. So if you have $100 and you put that money into a savings account, you'll earn, after about a year of keeping it there, another dollar. You'll have $101. If you put it into a CD, you might have $102. Meanwhile, inflation is happening right now at about 2.5%. So even CDs aren't really holding on to the value of the money that you've had when you first earned it. So what is a hardworking person to do? Well, investing in stocks, as I said, is a great way to avoid that problem of shrinking dollars. On average, the rate of return for money invested in one particular group of popular stocks, called the S&P 500, over a 10-year period is about 13%. So that $100 would instead be worth $113. If you don't do anything with it, it'll only be worth $98. These statistics come from a website called Statisha.com, and those are current. Investing, though, does have risk. If you put your money in the bank, it'll be protected by the federal government. And even if the bank folds, your money will come back to you. You'll get it back. That's not true for the stock market. So as financial advisor Matthew Frankel with the Motley Fool says in his 2021 article called How to Invest in the Stock Market, a step-by-step beginner's guide, he says, don't ever put money in the stock market that you'll probably need within the next 5 years. So what you need to do first is pay your bills. Second, put some money away for an emergency fund. Third, if you plan to buy a house, you want to begin to save for that down payment first. And only after you've done all those other things, then you might have some money to do something with, like investing. Since you all are young, you can probably handle the risk of investing in the stock market better than someone who's pretty close to retirement, because you're still earning money, whereas someone who's pretty close to retirement is getting to the point where they're going to be on a fixed income and they can't take that risk anymore. So how do you get started investing in the stock market? Well, if you're working for a company that offers a 401k or some other kind of retirement plan, then you probably already have some money invested in the stock market. A 401k is a way that your employer helps you to save for retirement. You allow them to take some money out of your paycheck before taxes are taken out, and they match that money with some money that they actually just give you, and then they hand that money over to the 401k management company, and those managers will invest that money for you. They'll probably invest it in a mixture of various different kinds of stocks and some bonds and some other types of investments. And these mixtures are called mutual funds, and that's commonly where 401k money gets put. You get to tell your 401k management company what kind of investments you prefer. You choose safer ones that probably have a little less return, or you could choose slightly more risky ones that might have a higher rate of growth, or they may not be safe places at all. So you get to decide how much risk you want to take. But you can also invest on your own without your employer being involved. Since buying and selling stocks happens on marketplace exchanges, like called the stock exchange, like the New York Stock Exchange or the NASDAQ, you have to join a group that gives you access to that marketplace. It's like joining Facebook Marketplace in order to buy and sell through Facebook. So if you invest on your own, then you want to go through a broker, someone who works for a company called a brokerage firm and who gives you access to that market. If you want to be really involved in buying and selling stocks on your own, like making the choices of which ones to buy and sell and when, you can tell your broker through an app or in person what your goals are. And you could let your broker make those day-to-day decisions instead and just trust them and just have the money squirreled away with the broker and then just watch it over time. There are also what's called robo-advisors, in which the buying and selling is not done by a person, but by computer algorithms. So if you want to put a little bit of your money into stocks, do a little bit of homework, and then you'll be ready to go. Every broker charges fees, so it's important to do some research to see how much fees you might have to pay. At Investopedia, the money manager Chad Langager says in his 2021 article called A Beginner's Guide to Stock Investing that all brokers have to make money from their customers one way or another. And so there are going to be trading fees even if it looks at first glance like the company doesn't charge any fees. Trading fees generally range from somewhere between $2 per trade to $10 per trade on average. You also have to do your homework to make sure that the companies you're investing in are reputable companies or reputable sets of stocks. Look at how long the company's been around and look at the reputation that it has. Don't put all of your eggs in one basket. If you diversify, then you're reducing your overall risk. And diversifying means investing in different types of stocks, not just putting all of your investment money in one stock. So, for example, if you put all of your money in renewable energy stocks, and then a new administration comes into office that's actually much more oil friendly, you might find that the value of your stocks drop, at least for some years. And so if you only have that one kind, then you won't have anything that's growing at the same time. But if you have your stocks spread out a bit among different industries, you'll be a lot safer. The Matthew Frankel from The Motley Fool gives good advice, though. He says to make sure you invest in industries that you yourself are interested in. That way you'll be interested in following the news about how that industry is doing and when it might be time to buy or sell. If you're totally allergic to that kind of research, then a mutual fund might be the best bet for you, either through your works 401k or one that you obtain through a broker. According to the website NerdWallet, the best discount online brokers in 2021 are E-Trade, TD Ameritrade, Webull, JP Morgan, and Robinhood. Each of them have low fees and no minimum amount is required for you to begin investing. So if you hate the thought of your hard-earned money shrinking in value as it sits in the bank, then moving some of your money to stock market investments might be for you. First, make sure that you have that emergency fund set aside. And then decide if you'd rather be more or less involved in the management of your investments. If you like to be hands-on, there are some great apps that I mentioned that make investing in individual stocks or groups of stocks pretty easy. But if you prefer a hands-off approach, you can choose to invest through your 401k or through mutual funds. Either way, if you're careful and patient, you have a really good chance of seeing your money grow instead of shrink. You worked hard to earn it, and you deserve that. Thanks.